Oracle stock. Sell-off explained. Should investors be concerned? Oracle's latest earnings release surprised investors and sparked a steep sell-off, with the share price sliding more than 12% shortly after the results were made public. In this overview, I'll break down the key takeaways from the report, explain why the market reacted so strongly, and discuss what this means for Oracle's outlook. I've also adjusted my valuation to reflect the new information, and will share how I currently view the stock. A major point of focus was the company's remaining performance obligations, which climbed to roughly $523 billion, more than 4 times higher than a year ago. Earlier in the year, this rapid expansion in contracted business was viewed as a major positive for the stock. Now, investor sentiment has shifted. Market participants are increasingly scrutinizing the quality of these commitments, questioning who the customers are, whether they have the financial capacity to honor the contracts, and how much pricing flexibility Oracle may have given up to secure them. Another growing concern is the sheer level of investment required to fulfill this backlog. What once looked like a clear long-term growth driver is now being seen by some as a near-term challenge, as rising capital spending and margin uncertainty weigh on profitability. For the quarter, Oracle reported revenue growth of 14%, bringing total sales to approximately $16 billion. While this represents healthy growth in isolation, it fell short of expectations given the size of the company's order book. This reinforces the view that Oracle needs to significantly expand its infrastructure before it can fully convert demand into revenue. Operating income increased to $4.7 billion, while operating cash flow over the past 12 months rose to $22.3 billion, about 10% higher than the prior year. Although these figures improved, they did not accelerate quickly enough to offset investor concerns, especially in light of the company's aggressive spending plans. During the quarter, Oracle secured an additional $68 billion in new performance obligations, a 15% increase from the previous quarter. These deals included commitments from financially strong companies such as Meta Platforms and NVIDIA. Notably, OpenAI was not highlighted, likely reflecting investor unease. Despite signing large contracts, OpenAI continues to post heavy losses, raising questions about its ability to fund those long-term commitments. This issue extends beyond Oracle and points to a broader challenge within the AI industry. Many AI services are offered at little or no cost, even though they require massive computing resources. Key questions remain around how these platforms will monetize their offerings, whether users will tolerate higher prices, and if sustainable profitability is achievable at scale. In a separate strategic decision, Oracle exited its investment in Ampere, adding $2.7 billion to profits. Management explained that developing proprietary chips is no longer central to its strategy. Instead, Oracle is embracing a hardware-agnostic approach, working closely with a wide range of CPU and GPU providers rather than prioritizing its own designs. This strengthens partnerships with companies like NVIDIA and gives customers greater flexibility. Oracle also reaffirmed its quarterly dividend of 50 cents per share, though this payout is now being watched more closely. Capital expenditures are running well ahead of operating cash flow, placing pressure on free cash flow. While no changes to the dividend have been announced, it remains a potential risk if spending continues at current levels. One encouraging sign is that Oracle was able to grow revenue while slightly reducing sales and marketing expenses. This suggests demand is being driven organically rather than through increased promotional spending, which is generally a positive indicator for long-term business health. Still, the balance sheet remains a critical consideration. Oracle significantly boosted its cash position by borrowing in preparation for large-scale infrastructure expansion. Investments in property, plant, and equipment rose by roughly 50% in a short period, reflecting the rapid build-out of AI and cloud capacity. While these assets are in high-demand areas, they come with increased financial risk. Total debt climbed from around $85 billion to nearly $100 billion, and could continue to rise as expansion efforts proceed. Capital spending has grown far faster than operating cash flow, and this widening gap is the primary source of investor concern. That said, Oracle's situation differs from cases like Intel in the past. Unlike Intel, Oracle already has substantial customer commitments in place, reducing the risk that new infrastructure will go unused. Having firm demand also improves Oracle's access to financing, as lenders can clearly see how revenue will be generated once capacity is built. Even so, management may eventually need to consider additional funding options, including further borrowing, issuing equity, or, if pressures intensify, reevaluating the dividend. After incorporating the latest results into my valuation, I now estimate Oracle's intrinsic value to be in the range between $215 to $220 per share. With the stock trading near $190, it appears modestly undervalued considering a margin of safety. Forward valuation metrics, including price to earnings, forward price to earning, and price to operating cash flow ratios, also suggest the stock is reasonably priced. Besides, currently 47 analysts are covering Oracle stocks. 33 of them has a buy rating, 12 with hold, and 2 recommending sell. Average price target from analysts is on average is $300. Just to clarify that my intrinsic value of $215 means what Oracle stock worth today according to my calculation, and analyst price target is the forecasted price in next 12 months. Intrinsic value works as a guide to show what is a good price to buy a stock. An analyst forecast is a guidance what you can expect. Hope it is clear to everyone. Let's move forward. Despite a disappointing quarter, I continue to view Oracle as a buy. The underlying business remains solid, but investors should be aware that near-term risks around cash flow and execution have increased. Oracle has effectively told the market that generating future revenue will require higher capital investment in the short term, and that message has understandably unsettled investors. The biggest uncertainties now revolve around financing, the true strength of the order backlog, and whether all major customers, particularly those tied to AI, can meet their obligations. These concerns have grown in recent weeks, and Oracle's earnings report has brought them into sharper focus. Even with these risks in mind, I still believe Oracle offers an attractive long-term risk-reward opportunity for investors willing to tolerate short-term volatility. This is not a financial advice. I simply do valuation because I love doing it, and it goes well with my educational background of bachelor and master's in finance and accounting. Please invest with caution and stay away from leverage. Happy investing!